Let me ask you something. When you hear National Pension System, NPS, what's the first thing that pops into your head? For most of us, it's some kind of rigid, old-school government plan, right? Well, what if I told you that whole image is completely out of date? Today, we're going to look at the new, supercharged NPS. It's turned into a powerful personal wealth machine that, honestly, you probably don't know nearly enough about. So, here's our game plan. First, we'll tackle the old myths about what the NPS used to be. Then, we're going to uncover its power as a secret tax weapon and a seriously high-growth investment engine. We'll also break down a game-changing new rule for your retirement income. And finally, we'll lay out a simple plan so you can actually architect your own financial future with it. All right, let's just get this out of the way. For years, the NPS had this reputation, didn't it? It was seen as this inflexible, kind of boring government-mandated savings tool. Something you did because you had to, not because you really wanted to. Yeah, that's the story most people still believe, that it's this clunky scheme with a bunch of red tape and just meh returns. But that story, it's a complete myth today. In the next few minutes, we are going to totally dismantle that old idea and show you what the modern, dynamic NPS really looks like. Let's start with the first big reveal. The NPS isn't just another option you can stuff into your tax-saving basket. No, it's more like a secret weapon. It has a unique advantage that you literally can't get anywhere else. We all know about Section 80C. It's that crowded party, right? The 1.5 lakh rupee limit where you've got your PPF, your life insurance, ELSS, everything is crammed in there. And yeah, NPS can be part of that, but that's just the warm-up act. Now listen closely because this is the important part. Even if you have completely maxed out your 80C limit, NPS gives you an extra 50,000 rupee deduction on top of that. This is totally exclusive to NPS. It's under a special section, 80CCD 1B, and no other investment in India has this perk. And this quote? It absolutely nails it. It really is like finding a secret room in your house for saving tax. And only NPS gives you the key. This is a massive advantage that just sets it in a whole different league from everything else in your portfolio. And here's where it becomes real money. If you're in the 30% tax bracket, investing that extra 50,000 rupees means 15,000 rupees instantly comes right back into your pocket. Think about that. That's a guaranteed 30% return on day one, before your money has even started to grow in the market. What a head start. But tax saving is only half the story. Let's move on, because the other big myth we need to bust is this idea of low returns. The NPS of today is a powerful, market-linked investment engine that's actually built for growth. So the NPS puts you in the driver's seat. If you like to be hands-on, you can pick active choice. You're the pilot, deciding how much goes into different assets with up to 75% in equities. That's a lot. But if you'd rather just set it and forget it, there's auto choice, which is like an expert autopilot that dials down the risk for you as you get older. So think about it. Whether you're a finance geek like Arav, who loves tweaking his investments, or you're a busy professional like Daya, who just needs something smart and simple that works in the background, the NPS adapts to you. It's not a one-size-fits-all deal. It's your personal plan. Now here is the secret ingredient that really supercharges this whole thing. The fund management fees, they're capped at an unbelievably low 0.09%. I mean, to put that into perspective, most regular mutual funds you buy charge you over 1%, sometimes way more. That tiny difference in fees can literally mean tens of lakhs more in your pocket over 30 years. It's all thanks to the magic of compounding. And hey, the proof is in the pudding. Just look at the numbers here. You can see the performance across different time frames. Historically, NPS funds, especially the ones with a lot of equity, have been delivering compound returns in that 9 to 12% range. That's the powerful combo of high equity exposure and those ultra-low fees working together to build your wealth. Okay, now we get to what is maybe the single biggest upgrade to the NPS, a new rule that completely shatters that old myth of inflexibility and totally transforms how you get your money back when you retire. It's called the Systematic Lump Sum Withdrawal, or SLW. I know, it's a bit of a mouthful, but what it really means is that you can turn your retirement savings into a regular tax-free paycheck. Instead of having to take out a giant chunk of money all at once, you get to design your own cash flow. So, here's exactly how this retirement paycheck works. At age 60, 60% of your total corpus is yours, completely tax-free. Now, with the SLW, you just tell your fund manager, hey, pay me 50,000 rupees every month or whatever you need. You get this regular paycheck all the way until you turn 75. And here's the best part, the rest of that money just stays invested, continuing to grow. Your money keeps working for you even after you've stopped. So, what happens to the other 40%? Well, that part is used to buy something called an annuity, which is basically a promise from an insurance company to pay you a fixed pension for the rest of your life. It's your financial safety net. So when you put it all together, you get two income streams, a guaranteed lifelong pension from the annuity, plus a flexible, tax-free paycheck from your SLW that is still growing. It's an amazing strategy, and no other single product can do this. Okay, so we've busted the myths about the NPS being rigid and having low returns. We've uncovered this incredible two-income retirement strategy. It's obviously a really powerful tool. So the question is, how do you put this machine to work for you? Let's build a simple action plan. Honestly, making this work just comes down to a few smart habits. First, automate your contributions. Just treat it like an EMI for your future self so you stay disciplined. Second, really try to max out that full 2 lakh rupee tax benefit. That's the 1.5 lakh from ADC plus that special 50,000. It's the best start you can give your money. Third, just once a year, check in on your investment choice. Is active still right for you, or does auto make more sense now? And fourth, a simple but really crucial one. Make sure your nominee details are up to date. And if you're thinking, oh, this sounds like a lot of government paperwork, think again. The old bureaucratic hurdles are gone. The whole process is digital now. You can open an account online with your Aadhaar or PAN in like under 15 minutes. It's never been easier. So here's the bottom line. The modern national pension system gives you the tools to not just save money, but to actively design the retirement that you actually want to live. The power has shifted from a rigid system to you, the investor. So the question really isn't just if you will save, but how you will architect your future.
Okay, let's unpack this. For years, the National Pension System, the NPS, it was often framed, by planners, investors as kind of rigid, opaque even.
Conservative, definitely.
But yeah, too conservative. Yeah. Filed under mandatory government scheme, right? Not really a high-power wealth builder.
That was the perception, absolutely.
But based on this stack of sources we've got, something fundamental seems to have shifted.
Oh, definitely.
These big reforms, 2024, 2025, they're calling it NPS 2.0.
That's the term, yeah.
And it looks like it's really transformed the system. The narrative now is sophisticated, multifaceted wealth creation, even a management engine.
A big repositioning effort.
So this deep dive is really for you, the listener, to get why NPS is now seen as, well, one of the most potent and flexible retirement vehicles out there today.
It's fascinating when you look at the history, right? NPS wasn't just plucked out of thin air. It marks this huge paradigm shift away from India's old defined benefit obligations.
Right. The pre-2004 government schemes, where the payout was guaranteed, fiscally tricky.
Exactly. Fiscally unsustainable in the long run. So we moved to this defined contribution model, market-linked, sustainable.
And the scale is massive now.
Huge. Over 7.7 crore subscribers. And the assets under management, the AUM, it's crossed, 11.3 lakh crore? It's enormous.
Wow.
So Our mission today really is to decode these strategic policy-driven changes. We're talking tax incentives, investment power, even how you take the money out.
And see how it empowers you, the individual investor, especially non-government folks.
Precisely.
Okay, before we get into the really dramatic upgrades, let's nail down the basics. The foundation.
Good idea.
This new account system. We need to get that straight first so we know where all these new features actually fit.
Absolutely. Think of it like two separate vaults under one roof for different needs.
Okay.
The main one, the core, that's tier I. This is your primary retirement account, your long-term commitment device.
Right. And contributions here are locked in until age 60.
Locked in tight until 60. And crucially, this is the only one eligible for those big tax benefits we'll get into.
Forces that long-term discipline.
It does. And you just need a small minimum contribution each year to keep it active. Just 1,000 rupees. Symbolic, really.
But that lock-in, that scares people sometimes, right? The idea of money being completely inaccessible.
That's the psychological hurdle. Yeah. Absolutely. Which is where the second vault comes in.
The safety valve.
Exactly. Tier 2, it's optional, voluntary, an add-on savings account.
Okay.
It's basically there to tackle that fear of having all your retirement savings locked away.
So tier 2 gives you liquidity.
Complete liquidity.
Yeah.
Immediate. You can pull funds out anytime, no restrictions, like a liquid mutual fund almost.
And there's a trade-off.
Big trade-off. Contributions to tier 2. 0 tax benefits. None whatsoever.
Okay. So tier 1 for discipline and tax breaks. Tier 2 for flexibility.
You got it. Balances required discipline with that needed accessibility.
Right. Now let's talk about the fuel, the accelerator. This is where NPS really starts to shine, I think. That triple tax benefit structure. This seems like its major competitive edge over, say, PPF or even mutual funds.
It is. It's a direct, policy-driven wealth accelerator. Let's break down those 3 layers. Under the Income Tax Act.
Okay, layer 1.
Layer 1 is the familiar one, Section 80C. Your own contributions to your Tier I account, deductible up to that standard limit.
The 1.5 lakh limit, same as PPF, ELSS mutual funds.
Exactly. Standard stuff. Puts it on par.
But then comes the second layer. This is the secret weapon, right? The exclusive bit.
This is the kicker. Section 80CCD 1B. You cannot get this anywhere else.
Okay, explain that.
It's an exclusive additional deduction keyword. Additional. It's for 50,000 ARJ.
Over and above the 1.5 lakh.
Over and above the ADC limit.
Yeah.
So think about someone already maxing out their ADC, maybe a salaried professional, a high income, 30% tax bracket.
Yeah.
They put an extra 50,000 into NPS Tier I. That contribution gives them an immediate guaranteed tax saving right off the bat.
How much saving are we talking?
Well, at the highest slab, say 30% plus cess, maybe around 31.2%. On 50,000, that's about 15,600 saved. Instantly.
15,600 rupees back in your pocket just for contributing before any investment growth.
Exactly. Cash saved. It's an incredible immediate return on investment. Hugely compelling.
Wow. Okay, that's powerful. Now, the third benefit, Section 80CCD2. This one's about the employer's contribution for salaried folks.
Right. And this has become super important with the new tax regimes coming in.
How so? What's changed here?
Okay, so for private sector salaried employees, the limit for the employer's contribution that's deductible has been boosted. Budget 2025 proposals pushed it from 10% up to 14%.
14% of salary.
Crucially, salary here means basic pay plus dearness allowance, or DA, not your entire CTC, just basic plus DA.
Okay. And the deduction limit.
Here's the beauty. The employer's contribution up to that 14% mark is fully deductible from your taxable income. And there's no upper monetary ceiling on this deduction itself.
No ceiling, unlike the 1.5 lakh or the 50K.
Correct. The limit is the 14% of basic plus DA. If that percentage amounts to a large number for a high earner, that entire amount is deductible.
So this makes the corporate NPS route potentially massive for tax saving, especially for higher earners.
Absolutely massive. As long as your employer is participating and making that contribution, it's a superior mechanism.
Okay, let's pause here because this is where people get confused. The old tax regime versus the new tax regime.
Yes, a very common point of confusion.
A lot of people think, okay, I'll go for the simplified new regime, pay less paperwork, but I lose all my NPS tax breaks. Is that right?
Not entirely. That's the key nuance. If you choose the new tax regime, the simplified one, yes, you do lose the benefits tied to your personal contributions.
So the standard ADC part and that special ADC CD1B for 50K, gone under the new regime.
Gone. Explicitly not available. That's the trade-off for the simplicity and potentially lower rates of the new regime.
Ah, okay. But what about the employer part? Section ADC CD2.
That's the strategic move by the policymakers. The employer contribution deduction under ADC CD2 is retained.
Yeah.
And it's enhanced to that 14% limit we talked about.
In both regimes, old and new.
In both regimes. That's the crucial point.
So even if I ditch all other deductions for the new regime, if my employer contributes to my NPS, I still get that tax deduction up to 14% of basic plus DA.
You absolutely do. It makes the corporate NPS contribution arguably the single most powerful tax-saving tool left for salaried individuals under the new tax regime.
Wow. That changes the calculation significantly.
It's a clear policy signal. They want to encourage corporate involvement, keep retirement savings incentivized, even under simplification. If your employer offers NPS, grabbing that ADC-CD2 benefit is almost a no-brainer, regardless of which tax regime you pick personally.
Okay, so accumulation phase looks incredibly tax efficient. What about when you retire? Maturity. People hear EE status exempt, exempt, exempt. Does NPS truly deliver that?
It's generally called E, but there's a very important but. You need to understand the structure at exit. When you exit, typically at age 60, up to 60% of your total corpus can be withdrawn as a lump sum, and that's 60% completely tax exempt.
Okay, 60% tax-free. What about the rest? The other 40%?
The remaining minimum 40% must be used to buy an annuity plan from an approved insurance company and an annuity service provider.
An annuity to give you a regular pension income for life.
Exactly. Now, the money you use to buy that annuity, that 40% portion, that investment is also tax exempt at the time you buy it.
So far, so exempt, exempt. Where's the third E or the catch?
The catch, or rather the clarification, is on the income from the annuity. The regular pension payments you receive month after month, year after year.
Yeah.
That income is treated as normal income for that financial year. It gets added to your other income and taxed at whatever your applicable income tax slab rate is.
Ah, so the pension itself is taxable.
Correct. So accumulation is exempt. Withdrawal of the lump sum up to 60% is exempt. Investment into the annuity is exempt. But the resulting annuity income is taxable. EE, if you want to be precise, for the income stream part.
Right. That's a critical distinction for retirement planning. Need to budget for that tax.
Absolutely. You need to factor that tax liability into your post-retirement cash flow projections. Okay, so we've covered the tax framework. Now let's shift gears to the engine room, the investment mechanics. This is where NPS 2.0 really revs up.
Right. The multiple scheme framework, MSF. Effective October 1, 2025. This sounds like it fundamentally changes the investment game for non-government folks.
It absolutely does. It moves NPS from, well, a somewhat rigid structure to a much more dynamic portfolio tool. It re-architects the investment DNA.
Under the old system, it was like you picked one path, right? Active choice, maybe auto choice. And you were kind of stuck with that one pension fund manager, one set of schemes under your PRN.
Yeah, the old rule was basically one PRN, one scheme choice. Very monolithic.
So how does MSF dismantle that? What's the new deal?
MSF flips that completely. It allows you, the subscriber, to hold and contribute to multiple schemes from different pension fund managers, all under your single PRN.
Wait, different managers simultaneously?
Yeah. Simultaneously. So, for example, you could say, okay, I want an aggressive equity-heavy fund from PFMA, maybe aiming for high growth.
Right.
And at the same time, I want a really conservative government bond fund from PFMB for stability.
You can allocate your contributions between them.
That's huge.
Yeah.
That proper portfolio diversification within NPS itself.
Exactly. Before MSF, if you wanted that kind of multi-manager, multi-strategy approach, you had to use different products outside of NPS, like mutual funds. Now you can potentially do it all inside the NPS wrapper. It's a game changer for sophisticated investors.
And speaking of aggressive, this ties into the other massive shift, risk appetite. NPS was always seen as conservative. The old cap on equity was 75%, even in active choice.
75% was the ceiling.
What's the new limit under MSF? This sounds radical.
It is radical. The MSF essentially shatters that 75% equity ceiling for non-government subscribers. It moves NPS squarely into high-growth territory.
How high?
The new framework allows allocations of up to 100% in equity.
100% all in stocks. In specific high-risk variants that PFMs can offer under MSFs. Yes, up to 100% equity.
Wow. That's a massive psychological and regulatory shift. How are they managing that risk perception?
Well, PFMs are now required to offer at least a moderate risk option and a high risk option within MSF. And crucially, every scheme has to have a standardized riskometer.
Like the ones on mutual funds.
Exactly like those. So you, the investor, can clearly see the level of risk you're taking on with a particular scheme. It's about informed consent.
Okay, let's quickly recap the asset classes available. We know E is equity, up to 100% now, potentially. What are the others again?
Sure. So E is equity-listed shares, highest risk return potential. C is corporate debt bonds from companies, medium risk. G is government securities, central and state government bonds, considered the safest.
Right.
And then there's A, alternative investment funds. Things like REITs, invitees, infrastructure funds. But allocation to A is capped.
How much?
Capped strictly at 5% of your total portfolio.
Right.
Due to their complexity and liquidity profile. So mostly E, C, and G for the bulk of it.
Okay. More choice, higher equity. This brings up the cost question. NPS was famous for its dirt cheap fees. That 0.09% investment management fee, IMF, was a huge selling point.
Ultra low, almost negligible. And that low cost compounds massively over decades. It's often called guaranteed alpha because saving on fees is a guaranteed return boost.
Absolutely. Compared to typical mutual funds charging 1.5% or more, that 0.09% could mean a final corpus maybe 30-40% larger just from cost savings alone over 30-40 years.
The math is compelling, yeah.
So if we're getting all this new flexibility, 100% equity, multiple managers under MSF, what's the catch on fees? Are these new MSF schemes still cheap?
That's the trade-off. The new MSF schemes operate under a different higher fee structure.
How much higher?
The cap for the IMF on MSF schemes is 0.30% of AUM. Plus, there might be some performance-linked incentives added on top.
0.30. That's more than 3 times the legacy 0.09%.
It is significantly higher, yeah.
How do they justify that jump? Isn't that going to put people off?
The regulator's justification is basically about making the pension fund management business more commercially viable. Managing multiple, customized, high-equity schemes. It needs better research, more complex systems, better talent.
Okay.
The higher fee is intended to incentivize that, to encourage PFMs to compete, innovate, and offer genuinely differentiated products under MSS. You're paying more for that potential customization and active management.
But what about people already in MPS who liked the old ultra low cost? Are they forced into these higher fees?
No, and this is important. The sources are clear.
Yeah.
The existing money, the large corp, is already built up in the old low-cost common schemes. That cannot be transferred into these new higher-cost MSF schemes.
Okay, so legacy money stays protected at 0.09%.
Exactly. MSF is only for fresh contributions going forward if you choose to opt into an MSF scheme. It protects the low-cost benefit people already have.
All right, so more freedom, higher potential return, slightly higher cost for the new stuff. But it sounds like the regulators didn't just open the floodgates. There are guardrails, right? This guardrailed freedom idea.
Yeah. Yes. Absolutely crucial. They built in some serious behavioral circuit breakers to stop people making emotional decisions in volatile markets.
Like what? What are the main guardrails?
The big one, a 15-year vesting period for switching funds between different MSF schemes.
15 years. 15.
Yes. If you choose an MSS scheme, say with PFMA, your money is essentially committed to that specific scheme and that PFM for 15 years. You can't just jump to another MSF scheme next year if you don't like the performance.
Whoa. 15 years feels like an eternity in finance. Isn't that incredibly restrictive? Won't that deter people even with 100% equity on offer?
It sounds very restrictive, I agree. But the policy thinking is clear. Long-term wealth creation needs discipline. needs patience. This lock-in forces you to stick with it.
Ride out the market cycle.
Exactly. Prevents panic selling during downturns. It forces adherence to that long-term compounding, even when it feels uncomfortable.
Is there any escape hatch during those 15 years if you really need to de-risk?
There is one limited option. During that 15-year MSF vesting period, you can choose to switch your investment out of the MSF scheme entirely.
Okay.
And move it back into one of the original low-cost, generally more conservative common schemes.
Ah, okay. So you can bail out of the high-risk MSF back to safety, but you can't just hop between different fancy MSF schemes.
Precisely. It's a safety valve, but it pushes you towards conservatism if you use it.
Yeah.
It's a very deliberate design balancing high growth potential with enforcing financial stability.
Okay, these accumulation phase changes are huge, but you mentioned earlier, the biggest complaint historically about NPS wasn't just the investment rigidity, it was the exit, the decumulation phase.
Yes, that was the constant feedback.
Yeah.
The inflexibility at retirement.
People felt forced to take that 60% tax-free lump sum all in one go at age 60. Suddenly, you've got this big chunk of cash to manage, maybe for the first time.
Right. It created a reinvestment risk, behavioral risk.
But that's changed now with the systematic lump sum withdrawal, SLW.
This is genuinely revolutionary for NPS. SLW tackles that exact problem. It recognizes retirees need income streams, not just a big pot of capital dropped on their lap.
So how does SLW work? What does it let you do with that 60% lump sum?
Instead of taking the 60% tax-free portion as a single payment at 60,
Yeah.
you can now choose to withdraw it systematically in installments. You decide the frequency, monthly, quarterly, semi-annually, annually.
Like drawing a salary from your own retirement fund.
Exactly like that. And you can structure these withdrawals to continue all the way up to age 75.
15 years of potential withdrawals from that 60% pot.
Correct. 15 years of flexible, tax-free income stream, essentially.
But wait, if I'm withdrawing systematically, say monthly, what happens to the rest of that 60% portion that I haven't withdrawn yet? Does it just sit there in cash?
No. And this is the really clever part. The remaining balance of your 60% lump sum portion, it stays invested in your chosen NPS funds.
It continues to grow, even while I'm withdrawing from it.
It continues to participate in the market, earning potential returns, compounding. This is huge for beating inflation over those 15 years. Far better than pulling it all out and sticking it in a bank FD.
Okay, that sounds amazing. Flexible, tax-free paycheck that keeps growing. But what about the risk? If the market tanks right before my next withdrawal?
That's the key risk management consideration, absolutely. If you're using SLW, you probably wouldn't keep that 60% portion allocated to 100% equity anymore.
You'd de-risk it.
You'd likely shift it towards lower risk options, maybe the corporate debt funds or the government securities G funds. The system allows you to change your allocation for this portion.
So you manage the drawdown risk yourself.
Exactly. You balance your income needs against your risk tolerance for the remaining capital. SLW gives you the control to do that, perhaps with advice from a financial planner. It's a massive leap in flexibility.
But we still have the mandatory annuity part, right? That hasn't gone away.
No, the mandatory annuitization rule is still there. It provides that safety net of guaranteed income for life.
So minimum 40% of the total corpus still has to buy an annuity.
Correct. Minimum 40% buys an annuity from an empaneled provider, ensures you have a regular pension income that you can't outlive, addresses longevity risk.
And that annuity income, as we discussed, is taxable.
Yes, that income stream is taxable. Lots of annuity options, though. Life annuity, annuity with return of purchase price for your nominee. Choices there.
Now, you mentioned proposals. In September 2025, there was an exposure draft. Not law yet, but indicating where things might go.
Yes, important to stress these are proposals,
Yeah.
but they signal a very clear direction towards even more flexibility.
What's the headline proposal regarding that annuity rule?
The most dramatic one. It proposes reducing the mandatory annuitization requirement for non-government subscribers from the current 40% down to just 20%.
20%. So if that happens.
If that becomes law, it would mean the potential tax-free lump sum you could withdraw at 60 using SLW or otherwise could increase from 60% up to 80% of your total corpus.
80% tax-free.
Well,
Wow, that would give retirees huge freedom, especially if they have other income sources.
exactly. Much greater control over their capital. There were other proposals, too, aimed at liquidity.
Like what?
Suggestions to allow non-government folks to exit NPS entirely after maybe 15 years of subscribing under certain conditions. Currently, it's more restrictive.
Okay.
And also raising the limit for withdrawing the entire corpus if it's small. Currently, if your total corpus is below euros lakh at retirement, you can take it all, no annuity needed. They proposed raising that limit to maybe 12 lakh.
So making it easier for people with smaller pots to just access the whole amount.
Right. All these proposals together just reinforce the theme, making NPS less rigid, more liquid, more user-friendly. Okay, beyond the core NPS changes, the system is also branching out, expanding its ecosystem, trying to cover more demographics. It's like a cradle-to-grave strategy almost.
Let's look at the cradle end first. NPS Vatsalya launched September 2024. This is for kids, right?
Yes, Vatsalya is specifically designed for minor children under 18. Parents or guardians can open an account for them.
What's the goal here? Just getting them started early.
The goal is pure long-term compounding. Leverage decades of growth. Minimum contribution is tiny, just $1,000 a year. Guardians choose the investment mix, often active choice, up to 75% equity.
So give the child a massive head start. By the time they retire, 40, 50 years later.
They'd have a huge professionally managed corpus waiting for them. It's about embedding the saving habit early and maximizing time in the market.
But I heard the exit rules for Vatsalya are super strict, much tougher than regular NPS. Why?
They are incredibly strict, yes. It's by design. You ensure the money is actually used for the child's long-term security, not blown at age 18.
What's the rule?
If the Vatsalya corpus is over 2.5 lakh when the child turns 18, a mandatory 80% of it must be used to buy an annuity.
80% annuitized. Wow, only 20% lump sum.
Exactly. Compare that to the standard 40% annuity rule. It's much stricter. The regulator is basically forcing that young adult to immediately lock in a long-term pension income stream.
Making sure the old age security goal of Vatsalya isn't derailed by youthful spending temptations.
You got it. It locks in the intended benefit.
Okay, now shifting to the other end of the spectrum, government employees. There's this new Unified Pension Scheme, UPS, came in April 2025. This sounds like a political compromise.
It absolutely was. A direct response to years of demands from government employee unions wanting to go back to the old defined benefit system, the OPS.
So UPS is trying to bridge that gap. How does it work?
It's a hybrid model. It offers government employees something NPS doesn't. An assured defined payout. Specifically, 50% of the last average basic pay as pension.
Guaranteed 50%. That sounds appealing. Who takes the investment risk to generate that guarantee?
A government takes the risk. Unlike NPS, where the market risk is borne by the individual subscriber, under UPS, the government guarantees the 50% payout and manages the investments needed to fund it.
So certainty for the employee. Plus, I assume, other benefits similar to the old system.
Yes, things like family pension benefits, dearness relief linked to inflation on the pension amount, features NPS doesn't typically offer.
Okay, so you have NPS with market links and high growth potential, and UPS with guaranteed 50% payout but maybe lower upside. Government employees had a choice to switch from NPS to UPS, right?
They did. There was a window to opt into UPS.
Given the guarantee, you'd expect a flood of people switching, especially those closer to retirement.
That's what many predicted. But the source material shows a surprisingly tepid response.
Tepid. How few switched?
Less than 5% of eligible government employees actually chose to move from NPS to the safer UPS. It was so low, the government had to extend the deadline to November 30, 2025.
Less than 5%. That's fascinating. What does that tell us?
Well, it could be a few things. Maybe the UPS rules were just too complex, poor communication, bureaucratic inertia always plays a role.
Sure.
Or, and this is the intriguing part, it suggests a higher level of financial sophistication among government employees than perhaps assumed.
Meaning they ran the numbers.
Possibly. They might have calculated that over a long career, even with market volatility, The potential corpus growth in NPS, especially with, say, 75% equity, could generate a much larger final amount, and therefore potentially a higher actual pension income even after buying an annuity than the guaranteed 50% from UPS.
So they chose potential higher growth over certainty, betting on the market and NPS.
It seems a significant number did. They might have decided the market risk was worth taking for the potentially much higher reward. It's actually a strong, implicit vote of confidence in NPS's growth potential.
Okay, fascinating dynamics there. Let's shift to the plumbing, the practical stuff. All this flexibility and complexity needs a solid operational backbone. NPS has this unbundled structure, right? Lots of different players.
Exactly. That unbundling is key to efficiency and keeping costs down. You have the main regulator, PFRDA, then the NPS Trust acting like the guardian of the funds. Multiple central record-keeping agencies, CRAs. Companies like Protean, K-Fintech, CAMS, they handle all the data and accounts.
The digital infrastructure.
Right. Then you have the pension fund managers, PFMs, the ones actually investing your money. A trustee bank handles the money flow. And finally, the points of presence, POPs, banks, post offices.
Yeah.
They're the front end where you might interact.
Lots of checks and balances built in.
Definitely. Designed for efficiency and security.
So for you, the subscriber, what are the absolute must-know logistical points? Let's start with portability. Job changes are common.
Portability is seamless. The key is your PRAN permanent retirement account number, that unique 12-digit number.
Like an Aadhaar for your pension.
Exactly. Your PRAN stays with you for life. Doesn't matter if you change jobs, move from private sector to government, move cities, you just give your PRAN to your new employer. Continuity is maintained.
And you can only have one PRAN, right? One tier 1, one tier 2 linked to it.
Correct. One TRAN per individual. Keeps it simple.
What if I'm not happy with my PFM's performance? Can I switch? We talked about the 15-year lock-in for MSF schemes, but what about the regular schemes or before opting into MSF?
Yes, you can switch your PFM. The rules encourage looking at long-term performance, maybe 3-5 years, not just short-term blips.
How often can I switch?
You can switch your PFM once per financial year. The process is usually straightforward, often online, no charges, no exit loads.
But there's a cooling off period.
Yes, you can't make another PFM switch within 3 months of your last one. Just prevents excessive churning.
And I can change my investment mix too, the ECGA allocation.
Yes, you can change your asset allocation mix twice per financial year. The first change in a year is typically free. Gives you flexibility to adjust your risk profile as needed.
Okay, good to know. Now, switching focus to employers offering NPS, compliance seems really important here, getting it right for their employees.
Absolutely critical. The compliance framework is quite strict to protect the employee's interests.
What are the main areas employers need to watch out for?
First is contribution accuracy. They must correctly calculate the contributions based on the right definition of salary basic plus DA, and apply the correct rates, 10% employee, if applicable, 14% employer for private sector.
And this needs to match payroll records, Form 16, etc.
Perfectly. Mismatches cause huge problems downstream for the employee's tax filing and final corpus. Cross-verification is key.
And the timing of sending the money, that seems crucial for compounding.
Hugely crucial. Remittance timeliness. Employers have to deduct the contributions and, importantly, upload the subscriber contribution file, SCF, to the CRA system and remit the actual funds.
By when?
By the 10th of the month following the month the salary was paid. So April salary contributions due by May 10th.
And if they're late?
Penalties kick in. It's calculated as either 10 per day of delay or interest at the current bank rate plus 2% on the delayed amount for the delay period, whichever calculation results in a higher penalty.
Ouch. Strong incentive to be on time. Ensures the money gets invested ASAP.
Exactly. It protects the employee from losing investment days due to employer delays. Fiduciary responsibility.
And finally, systems security. Accessing the CRA portal to manage contributions must be tightly controlled.
Extremely. The CRA systems mandate things like multi-level access. You have an administrator, a maker role, prepares the contribution files, and a checker role, approves them.
Segregation of duties?
Yes. No shared passwords allowed.
Rigor.
Robust security like two-factor authentication, maybe IP address restrictions, and a strict rule. All system access passwords must be changed every 90 days.
Thus, audits.
Mandatory annual audits by external auditors to check the whole corporate NPS process, contributions, timeliness, security. It's a high-integrity framework. So we zoom out and try to synthesize all this. What's the big picture? The core promise, old age income security, that remains.
Yeah.
But NPS is just fundamentally different now. It's shed that rigid conservative skin.
It's dynamic now, competitive, playing in the same league as mutual funds.
Absolutely.
Yeah.
NPS 2.0 is this sophisticated balancing act.
Yeah.
On one hand, you've got maximum growth potential, 100% equity, the multiple scheme framework for customization.
High octane stuff.
But on the other hand, you have built-in structural discipline. Those long lock-ins, the 15-year MSF vesting, the strict Vasalia annuity rules. It forces a long-term view.
And then the SLW feature completely changes the retirement experience.
Revolutionary flexibility in the payout phase. It's constantly evolving.
Yeah, we've covered those three pillars, really. The fuel, that triple tax benefit, especially that unique 50,000 extra deduction, Section 80 CCD 1B, compounding over years.
Huge upfront incentive.
The engine,
Yeah.
the investment side, market-linked, highly customizable now, up to 100% equity if you want it.
Choice and control.
And the distribution system,
Yeah.
that SLW feature, giving you that tax-free growing paycheck in retirement. It flips the script. NPS isn't just mandatory anymore.
It's a strategic financial choice, arguably one of the most powerful available, especially for salaried individuals.
And the ongoing changes, those proposals to maybe cut mandatory annuity to 20%, new schemes like Vatsalia, even the UPS experiment, it shows the regulator is actively trying to make it better, right?
Constantly refining it, responding to feedback, addressing different needs, aiming for better long-term outcomes for citizens.
So wrapping this up, what does this all mean for you, the listener, the individual investor?
I think the biggest takeaway is that NPS 2.0 has shifted the power dramatically.
And the responsibility.
And the responsibility, absolutely. Squarely onto your shoulders. You're not just a passive saver in some fixed government scheme anymore.
You have real choices now. High growth, market-linked NPS. Assured benefit UPS if you're eligible. Which specific funds within NPS? How much risk?
Exactly. A whole spectrum of choices, each with different implications.
Which leads us to the final thought, the provocative question for you to mull over. In planning your own financial future, given these powerful tools like NPS 2.0, should your priority be chasing maximum market participation, aiming for the highest possible growth, maybe with that 100% equity option? Or should you prioritize guaranteed predictability, that peace of mind, even if it potentially means lower returns? And maybe the bigger question is, how much financial knowledge, how much active engagement are you willing to commit to make that crucial decision confidently for yourself?